What's up guys, it's Trevor here today and welcome back to my channel. So are you intending to apply for any kind of credit in Canada or even anywhere in North America? Please be prepared with your credit score because most of the banks and the lenders that will ask you for your credit score whenever you want to apply for any credits with them. So what is the credit score? How does the credit score work and how to improve your credit score? I will do a detailed breakdown in this video for you. But just before we do that, please do me a small favor. Please hit that like button, hit the subscribe button below because that will help my channel enormously. If you have done that already, let's jump right into the video. So what is the credit score? A credit score is a number between 300 and 850 that depicts a consumer's credit worthiness. Credit scores are designed to predict the likelihood that the individuals will pay their bills as agreed. The lenders will use this score to evaluate the probability that an individual will repay the loan that they applied for. So it means that the higher credit score you have, the higher in the possibility that you will be get approved by the bank or the lenders for any kind of credits you apply for. Just one quick note for you, whenever you are applying for any kind of credits here in Canada, the lenders will be looking at many factors to get you the final approval, and credit score is only one of those many factors. In Canada, there are two main credit reporting agencies. They are TransUnion and Equifax. Because each credit bureau has their own scoring algorithm and scoring models, so you may see that you have different credit scores on their websites, but that's totally normal. Now let's get into how the credit scores are determined. So the credit scores are determined by 5 factors. The first of them will be the payment history. So for the credit history, it will show all the information on how you repaid all the credits that you borrowed from the banks on their credit products like credit card, loans, and mortgages. In addition to reporting about the numbers and the type of account that you paid on time, this category will also include any details about the late or missed payment that you've had, or any kind of bankruptcy, any collection information, or any delinquency. The credit history will also detail how many credit accounts that you have are delinquent in relation to all of the credit accounts you have on file. For example, if you have total 10 credit accounts on your file, but you have 5 delinquent accounts, so that ratio of 5 or 10, which is 50%, will have a huge negative impact on your credit score. The second factor is the credit utilization, which accounts for almost 30% of the credit score. A key part of the credit score will analyze how much in total that you are using on the credit products like the credit card or the revolving line of credit. A revolving line of credit is a type of loan that allows you to borrow the money, use the money, and then repay the money. And whenever you repay the money you borrowed, you can stop borrowing the money from that line of credit without applying for the line of credit again. To maintain a healthy credit score, it is important that you have to get your credit utilization rate below 30%. But the financial experts are recommending that if you want an excellent credit score, do not go over 10% with your credit utilization rate. The third factor is the credit history or the length of credit, and this category accounts for 15% of your credit score. This section of your credit file will detail how long have you got your credit accounts in existence. In general, the banks or the lenders, they really want to see that you are or you have been properly handling all the credit accounts that you have. The longer you can handle your accounts, it means that you are a more responsible consumer. The fourth category or the fourth factor is the types of credit, and this category will account for 10% of your credit score. So when we talk about the credit products, we may talk about the credit card, car loan, student loan, mortgages, or even the line of credit. The more diversified in credit products you have and you handle them properly, the higher the score you will have for sure. The last factor that affects your credit score will be the hard inquiries. So whenever you apply for any kind of credit in Canada, The bank or the lender will do a hard check on the credit score or the credit report, and that will be accounted as one credit hard inquiry. So the more hard inquiries you have on your credit report, it means that the lower credit score you will have. The reason behind this one is whenever you apply for credit products, it will be accounted as a one hard credit check, right? So the more hard credit checks you have, it means that you are applying for many credit products. And with that being said, the lenders or the banks will have an understanding that you will be a higher risk to them if they keep lending you their money. Just bear in mind that for a soft check, it will not affect your credit score. So what is a soft check? Whenever you want to check your credit score on the website like Equifax or TransUnion, it will be a soft check only and it will not affect your credit score. For the banks, they can provide you with an opportunity to check your credit score as well. For example, for RBC, you can check on your website. If you use CIBC, you can check on the mobile app, or you can use the Scotiabank mobile app as well. So what is a good credit score? On the Equifax website, they listed a range of credit score, and with an individual having a credit score of around 300 to 559, they list it as a poor credit score. From 560 to 659 is fair. From 660 to 724 is a good credit score. From 725 to 759 is very good, and from 760 to above, that is excellent. So with that 5 factors that determine your credit score, there will be 5 things associated that will help you increase or improve your credit score. The first thing that you have to do is always pay your bills on time and never miss a payment. So as you remember, for the payment history, it will account for 35% of your credit score. So if you miss or you have in a late payment, just only one time only, it will still have a very, very bad impact on your credit score. The second thing is always try to bring down the balance you have on your credit products like credit cards or line of credit, and in the same time you should always try to increase the credit limits that you have. So by doing these two at the same time, you can always bring down your credit utilization rate, and that will help you increase the credit score. The third note is that don't ever close any credit product or any credit card that you have been using for a very long time. The reason why is for the credit history, it will take into account your very first credit products you have. So if you close that credit product, it means that your credit history will be shortened enormously. Just for example, if you have a credit card that you opened 5 years ago, and after that one you only have another student loan like you just opened that 1 year ago. So right now it means that you are having a credit history of 5 years in general, but if you close the credit card and you only just leave the student loan on your name, it means that instead of having 5 years in credit history, you will now have only 1 year on the credit history, which is a very, very negative impact. The fourth tip is try to diversify your credit products portfolio. So the more credit products you have, the more likely that the bank or the lender will be able to lend you the money in the future, right? So instead of having only one credit card, try to have 2 or maximum 3 credit cards at the same time, or even you can get a line of credit under your name. The final tip is try to avoid applying for credit products back to back. So whenever you apply for credit products, it will be counted as a hard credit check. So if you are having too many hard credit checks on your profile, it means that you will see a very enormous drop in the credit score. So instead, I highly recommend you to accept the pre-approved offer or the pre-approval from the banks. So most of the banks, they just send out the pre-approvals or pre-approved offers on the credit card, on the line of credit, or even the car loan if you are doing good with your credit score. So try to accept those, because if it is a pre-approved offer, it means that they will not have to do any credit check or any hard credit inquiries, so they will not affect your credit score. So that is the end of the video today. I hope this video is useful for you when you build the credit score. And if you have any questions, just please feel free to drop it in the comment section below. I will answer all the questions I see in this section. And again, thank you so much for watching the video, and I hope to see you in the next video.